December 2024. The number just flashed across trading screens worldwide. $300 trillion. That's not a typo. That's not an exaggeration. That's the actual size of the global debt bubble. That's about to reshape everything you thought you knew about money, wealth, and financial security. Right now, at this very moment, you're witnessing the final act of the greatest financial experiment in human history. And here's what terrifies me most. Almost nobody sees it coming. They read too busy arguing about inflation rates and interest rate cuts to notice that the entire foundation of our monetary system is cracking beneath our feet. Let me paint you a picture. In the year 2000, total global debt represented roughly 62% of worldwide economic output. Today, that number has exploded to over 300%. We've quintupled our leverage in just 2 decades. Think about that for a second. Every country, every corporation, every household on Earth is drowning in obligations they mathematically cannot fulfill. But here's the part that should keep you awake at night. This isn't some random accident. This isn't poor planning or bad luck. What you're watching unfold is a precise, predictable mechanism that has destroyed civilizations, toppled empires, and rewritten the global order dozens of times throughout history. There's a name for this mechanism. Economists call it the Minsky Moment, named after a brilliant researcher who decoded the exact sequence of events that leads to financial collapse. And right now, in real time, we're watching every single stage of this pattern play out with mathematical precision. The Minsky framework reveals something absolutely crucial. Financial catastrophes don't just happen randomly. They follow a rigid 4-stage progression that's as predictable as the phases of the moon. Once you understand this pattern, you'll realize that what's coming isn't a possibility. It's a mathematical certainty. Stage 1 begins when a new monetary system gets established. Usually after some previous crisis, there's optimism in the air. Credit expands cautiously at first because the memory of past disasters still lingers. Everyone promises they've learned their lessons. This time will be different. Stage 2 is where things get dangerous. The cautious expansion becomes reckless. Debt explodes exponentially. Asset prices completely disconnect from any rational fundamentals. Leverage becomes normalized, celebrated even. Everyone genuinely believes the old rules no longer apply. This is where we enter what researchers call the speculative phase. Borrowers can barely service their interest payments, let alone pay down principal. But nobody cares because prices keep rising. Then it escalates to the Ponzi phase, where borrowers can't even cover interest anymore. They're borrowing just to make previous payments. Stage 3 arrives when something finally breaks. Could be a major bank, could be an entire country, could be a single asset class that everyone thought was bulletproof. But the psychology shifts instantly. What was considered rock-solid yesterday is suddenly recognized as catastrophically over-leveraged. Panic selling erupts. Liquidity vanishes overnight. Central banks and governments rush in with emergency measures. Bailouts, stimulus packages, interest rate cuts, anything to stop the bleeding. But here's the terrifying truth. By stage 3, it's already too late to fix the underlying problem. Stage 4 is the inevitable conclusion. Either the entire system collapses in deflationary chaos, or it gets saved through massive currency destruction. Savings get wiped out. Wealth transfers from ordinary people to those who position themselves correctly. The cycle resets, and the next regime begins. Now I know what you're thinking. This sounds like abstract economic theory. Let me prove to you that this pattern is absolutely real by walking through 3 historical examples where it played out with devastating precision. First, let's examine Germany in the 1920s. After World War I, Germany faced impossible war reparations totaling 132 billion gold marks. The country was economically shattered, politically unstable, and desperate for solutions. Stage 1 began immediately. The Weimar Republic established a new monetary system with the Reichsbank tasked with financing reconstruction and reparations. Initially there was restraint. Officials tried raising taxes and cutting spending. But the political will simply wasn't there. Stage 2 kicked in by 1921. The German government was funding deficits almost entirely through money creation. The Reichsmark started losing value slowly at first, then exponentially. Citizens and businesses, seeing the writing on the wall, began speculating in foreign currencies and hard assets. By 1923, the system had become a pure Ponzi scheme. The government was borrowing worthless marks to pay previous debts. Workers demanded payment twice daily because their morning wages were worthless by evening. A loaf of bread cost billions of marks. Stage 3 arrived with mathematical precision. The currency collapsed completely. Social order fractured. Political extremism flourished. From that chaos emerged nationalism, violence, and eventually the Third Reich. The pattern was complete. Let's jump forward to America in the 1970s. Different country, different decade, identical pattern. Stage 1 began with the Bretton Woods Agreement, making the dollar the world's reserve. Currency backed by gold at $35 per ounce. For 2 decades, this system worked beautifully. But by the 1960s, cracks appeared. America was funding the Vietnam War and massive social programs simultaneously. Other countries started demanding gold in exchange for their dollar reserves. The United States didn't have enough gold to cover the claims. Stage 2 began in earnest during the late 60s. Rather than tightening fiscal policy, America expanded the money supply. Inflation crept upward. By 1971, gold reserves were hemorrhaging. On August 15th, President Nixon unilaterally closed the gold window. The dollar became pure fiat currency. The speculative phase kicked in immediately. Oil prices quadrupled during the 1973 crisis. Inflation surged into double digits. The stock market crashed. The term stagflation was coined to describe the bizarre combination of stagnant growth and runaway inflation. Stage 3 hit in the late 70s. Inflation peaked above 14%. Interest rates skyrocketed. Paul Volcker raised the federal funds rate above 20% to crush inflation. It worked, but the cost was brutal. Deep recession, mass unemployment, entire industries collapsed. Stage 4 was a reset rather than total collapse. The dollar survived because of its reserve status and American military power, but the cost was borne by the middle class. Real wages stagnated for decades. Wealth inequality exploded. The precedent was set that America could print its way out of any crisis. Now we arrive at 2008. Same pattern, accelerated timeline. After the dot-com crash, the Federal Reserve slashed rates to 1%. Banks flush with cheap money started lending aggressively. Housing became the engine of growth. Subprime mortgages and complex financial instruments proliferated. The speculative mania reached fever pitch from 2003 to 2006. Housing prices doubled in many markets. People with no income were getting $700,000 mortgages. Banks packaged these loans and sold them globally. The entire system was leveraged 30-1 on the assumption that housing prices never fall. Stage 3 arrived in 2007. Subprime borrowers started defaulting. Bear Stearns collapsed. Lehman Brothers vanished overnight. The entire global financial system nearly seized up completely. Stage 4 was the largest coordinated bailout in history. The Fed dropped rates to zero and invented quantitative easing. Trillions of dollars were created and injected into the system. The banks were saved, but the cost was borne by savers and responsible borrowers. 3 different eras, 3 different countries, identical patterns. And now, right now, we're watching this exact same mechanism play out again, but this time the scale is unprecedented. This time, the entire global financial system is at stake. The current monetary regime began after 2008. Zero interest rates became the new normal. Quantitative easing transformed from emergency measure to permanent policy. Massive fiscal deficits were suddenly acceptable. The belief took hold that central banks possessed unlimited power to print without consequences. For over a decade, this regime seemed to work perfectly. Stocks climbed relentlessly higher. Bonds delivered steady returns. Real estate prices soared. Official inflation numbers remained mysteriously subdued. Everyone became convinced the Federal Reserve had cracked the code. Modern monetary theory gained serious academic credibility. Deficits didn't matter anymore. Debt was irrelevant. As long as you controlled your own printing press, you could create money forever. That was stage 1. Check. Now look around you. Look at where we are today. Stage 2 is screaming at us from every direction. Global debt has reached $300 trillion. American federal debt sits at $36 trillion and climbs by $1 trillion every 100 days. Corporate debt exceeds $11 trillion. Household debt tops $18 trillion. Margin debt in equity markets hit record levels before recent corrections. Private equity firms are leveraged to astronomical levels. buying companies with borrowed money, loading them with additional debt, then flipping them to pension funds. Zombie companies that cannot cover interest payments from actual business operations now represent nearly 20% of publicly traded firms. Cryptocurrency markets with zero cash flow trade at trillion-dollar valuations. Meme stocks rocket thousands of percent on social media hype. Retail investors gamble on options with money they borrowed against their homes. The speculative phase is complete. But we've moved beyond speculation into pure Ponzi territory. The system now depends entirely on continued money printing and artificially low rates to function. The moment liquidity contracts or rates rise meaningfully, everything collapses. Governments are borrowing new money to service existing obligations. Central banks are buying their own government's debt. This is textbook Ponzi finance. Stage 3 has already begun. The Federal Reserve raised rates from 0 to over 5% in less than 2 years. The fastest tightening cycle in modern history. And what happened immediately? The dominoes started falling. Silicon Valley Bank collapsed in March 2023. Signature Bank vanished overnight. First Republic, despite desperate rescue attempts, crumbled within weeks. Credit Suisse, a 200-60-7-year-old institution that survived 2 world wars, collapsed and was forcibly absorbed by UBS in a weekend emergency merger. The United Kingdom gilt market seized up so violently that the Bank of England had to intervene with emergency bond purchases to prevent a pension fund crisis. The United States Treasury market, supposedly the most liquid market on Earth, experienced unprecedented dislocations. Bid-ask spreads exploded. Price discovery broke down completely. Regional banks across America are sitting on hundreds of billions in unrealized losses because they purchased long-term bonds when rates were near zero. Those bonds are now deeply underwater. Mark-to-market accounting would reveal widespread insolvency throughout the banking sector. Commercial real estate markets are imploding in slow motion. Office buildings in major cities are worth 50 to 70% less than 3 years ago. Banks holding those loans face catastrophic losses. Shopping malls stand empty. Apartment buildings can't cover their mortgage payments as rental income falls short. The response has been exactly what the Minsky framework predicts. The Federal Reserve opened emergency lending facilities. The FDIC backstopped uninsured deposits far beyond legal limits. The Swiss National Bank provided unlimited liquidity to prevent Credit Suisse from taking down the global financial system. Central banks worldwide have already pivoted. Interest rate cuts are coming whether officials admit it publicly or not. Quantitative easing will return on a scale that makes previous programs look modest. They have no choice. The debt burden is too massive. The system is too fragile. If they don't print, the entire structure collapses immediately. Stage 3 is complete, which brings us to the final phase. There are only 2 possible endings to this pattern. History shows us both outcomes repeatedly. Either the system collapses entirely through deflationary depression, mass defaults, bank failures, and social breakdown, or central banks print on a scale never attempted before, destroying currencies and transferring wealth upward in the largest robbery in human history. The pattern is complete. The Minsky Moment isn't coming anymore, it's here. $300 trillion of debt cannot be repaid, only defaulted on or inflated away. And every government in history has chosen inflation over collapse. Your savings, your salary, your future are being quietly transferred to those who understand this mechanism. The greatest wealth transfer in human history is happening right now, and most people won't realize it until it's too late.